Hi, I'm Jim, and I was retired. As expected, the Federal Reserve cut rates now in the face of weakening labor market numbers and some rising inflation numbers. That'll go well, right? After keeping rates frozen for 5 meetings in 2025, the Fed's policymakers, the Federal Open Market Committee, decided to cut the policy rate by a quarter point to a range of 4 to 4.25%. And their dot plot now projects two more quarter point cuts by year end. And that would bring the Fed funds rate to about 3.5%, which according to one rule of thumb, would suggest that the median FOMC now believes inflation will be at 3% at year end. Is inflation baked in? Let's discuss. I believe that retirees should be concerned about inflation, and I have a focus on the Fed. I know not all of you appreciate it, but inflation means that your fixed income can be eroded, and the wrong actions on inflation can damage the economy and our investment portfolios. Stay tuned to the end of this video and I'll explain how I'm using this latest information from the FOMC and the Federal Reserve in my own investment decisions based on the current read of where inflation is heading. Now, both measures of inflation, both the CPI, which came out in the middle of the month, are heading back towards 3%. If you could see the blue line here, the consumer price index reached 2.9% for August year over year. Now, the Fed's preferred index is the Personal Consumption Expenditures, or PCE index, in yellow there. And in July, that was 2.6%. And we'll find out what the August reading is at the end of this month. Now, the Fed's policymakers this week met and made their latest decision on this green line, the federal funds rate. And that's the policy rate that they're using to try to control inflation. And it notched down to 4.25%, 4 to 4.25%. I'm showing the upper Fed funds limit in this green line. Now, some thought that it should have been cut half a point. The Fed doesn't like to work that way. They like to work in quarter points. And I had long expected a quarter point in September, not a half a point. The big news, though, was in the summary of economic projections. Now, in June, the SEP median was that the Fed funds rate would be 3.9% by the end of this year. But the September gave us a new SEP, and that now reads in September to be 3.6%. And that's a pretty significant move, a recognition that's going to take more than the 2 rate cuts that they originally thought. It's going to take the September 1, and 2 more rate cuts to get to that level. Here is that infamous dot plot from September. And now each of these blue dots represents the participants' guess of the appropriate Fed funds rate at year end. Now I'm going to superimpose this chart with the other chart of the inflation readings and the Fed funds rate. So you can see how they stack up with the dots projecting for year-end numbers. Now, a lot of people on the September SEP focused in on this lowest dot for year-end 2025. And many, maybe rightly so, assumed that this outlier is the newest governor, Stephen Moran, who just got there that day. And it looks like he penciled in a Fed funds rate for year-end of 2.9%. But let's compare again those dots with where we've been in the Fed funds rates and the inflation readings. Now, first thing I want to do is compare on that chart there the 3 red arrows here. And if you look at the yellow line at those spots, you can see when you could rightly say the Federal Reserve was too late. They were too late in 2021 thinking inflation was transitory. They were too late in 2024 to get around to making the first cut in the series of cuts to ease rates in 2024. And they were too late in 2025 by pausing that easing cycle. Now, what would happen if instead of pausing, they had gone on and made a series of quarter point cuts starting in January and running through the end of 2025? And if you carried that line through, you could see that Stephen Moran's number maybe isn't such an outlier. By the way, look at these blue dots here showing the median estimates for year-end PCE in 2025, 2026, and 2027. That dot in 2025 is the median estimate for 3.0% PCE inflation. That's a full point above their target. And in 2026, they're looking at about 2.6, and in 2027, they're looking at 2.1. When do you get back to your Fed funds target rate, guys? My prediction was that they would begin to cut in September. I saw that they were not interested in making any changes early on in the Trump administration until they understood more about what they might be expecting. So they paused. Okay, they paused way too long. And I believe then once the tariffs were announced, they decided that was a decision to pause longer. But in August, the FOMC finally got around to saying that, well, maybe they are only a temporary hit to prices and not the inflationary cost that they thought. But hey, what do I know? Hey, by the way, will you please take a moment to subscribe to my X feed at I Was Retired, the same handle I have here? I comment on inflation and my DIY retirement over there as well. Now, what am I doing with all this information? Well, lowering the rates would mean that I'm earning less on cash, and you need to be aware of that. Keep your cash bucket in as high yielding a savings account as you could find, and begin moving it into some short-term CDs to take advantage of some higher rates. Now, in my bucket one, I don't have anything that's longer than 3 years, so I'm really focused on short-term investments there. By the way, I did a video here where I described how I'm using individual tips and I bonds to provide some inflation protection for me in bucket 2, and that's the cash that I need for the 5 years after the first 3 years in bucket 1. And there's where I'm a little soft. Is inflation going to rear its head again or go back to target and stay there? I don't know. I'm not going to bet all the way one way or the other. Now, a portion of my bucket 2 assets have inflation protection. I did buy a TIPS in my tax deferred account earlier this year. And in October, we're going to use taxable dollars to buy an I bond. That October I bond has a 1.1% fixed rate. That means for the life of that bond, it will earn 1.1% over whatever the inflation rate is. So that's an ideal way of protecting some cash from inflation. Now, I've already done some calculations, and a I bond purchased in October for the first 12 months will earn something close to 4%. It's almost at 4% now with the rates you know for the first 6 months. The second 6 months will largely be decided in the next month or two in the CPI readings. As a reminder about I bonds, a portion of their return is that fixed rate. It's 1.1 for the life of the bond. But then every 6 months, it has an inflation factor. We already know what the October I bonds inflation factor is for the first 6 months. It was the rate that was set in May. Now, if you look at the numbers that are shaping up to be the inflation factor that will be announced on November 1, you can see it's going to be a little bit higher than the current inflation factor. So I am going to take some of our taxable dollars and invest in an I bond in October. Now, I'm not sure I'm going to go beyond that with I bonds because of all of the extra friction of having to purchase them in a Treasury Direct account. So this may be it for inflation protection unless inflation goes out of control again. And by the way, as I've said before, bucket 3 is equity, which in the long run is your best protection against inflation. How are you protecting against inflation? Drop me a comment below. And please remember to like, share, and subscribe to this channel if you like entertaining ideas from one DIY retiree to another. And I'll end with my standard warning. I am not an economist and I am not a financial planner. I'm just a DIY retiree sharing my lessons learned so that it might help you with your own DIY retirement. See ya.